Okay, good morning, everyone, and welcome to session 2 of our From Bids to Bricks series. On behalf of myself, I'm Jessica Foster from Gowling WLG and my co-chair, Kyle David from Aon. We wanted to extend a warm welcome to all of you, both those of you here in the room with us at the Gowling Toronto offices and those of you joining online. And once again, thank you so much for making time in your busy schedules to be here. Your participation and support is really what makes this possible. So thank you.
Good morning, everybody. We'll keep the introductions brief today as we'd like to save as much time as possible for the content and any questions you might have. Today's session is titled Laying the Foundation for Smarter Procurement, Strategic Contract Management, and Insurance. Over the next hour, we'll do a deeper dive into a few of the key construction insurances, as well as discussing procurement and contract management.
And just a couple of quick housekeeping items. If you miss anything today, or if you'd like to get caught up on session 1, you can find the recording available online on our website. Please also feel free to share the link with any of your colleagues who could not be here. And as a reminder, registration is already open for session 3 and 4 of our series. The next session is coming up on November 18th. So we hope to see you again, either here or online. And for those of you lawyers in the room, just a reminder, today's session can count as 1.25 hours of substantive CPD CLE hours. And finally, just like last time, for those of you who attended, you will be receiving a feedback survey after the session, and we would really appreciate it if you took time to fill it out because it does help us inform the content for the follow-on sessions, and we want to make sure that this is as useful and practical to you as it possibly can be.
Thanks, Jess. And with that, we'll be kicking off with the insurance portion. We'll be starting with Sean, who's going to be touching on the wrap up that we didn't get to finish off last session, as well as the builder's risk, and will be followed by Justin Perry from our environmental service group.
And just before we get into the insurance, I would just like to introduce my Gowling WLG colleagues who will be presenting immediately following. So we have my colleague Graham Regan out of our Gowling Ottawa office. In addition to being the firm's leader of the Supreme Court of Canada Services practice, Graham has also been ranked in chambers for his public procurement practice. And he's really the go-to at our firm for any of those thorny procurement issues that can arise. And also my colleague out of the Toronto office, we have Matthew Bernardo. He's a partner in our infrastructure and construction law sector group. And he has also been repeatedly ranked and recognized by his peers in the area of infrastructure law. Matt has represented numerous project consortia, procurement agencies, equity developers, and service providers across a wide range of very complex infrastructure projects. So a huge thank you as well to all of our presenters for being here today. With that, over to Sean and Justin.
Sure. Hello, everyone. My name is Sean Hoare. I run the construction and infrastructure practice at Aon in the province of Ontario. And today I'll touch on what we finished on last session, which was talking about some of the insurance products that are applicable to projects. We'll quickly go through builder's risk, which we touched on previously. And I'll talk about wrap-up liability, and then I'll turn it over to my colleague Justin to talk about pollution, environmental insurances specifically. So at the end of the day, insurance can be complicated insofar as the words that are in the policy document, but in principle, it's relatively simple, right? Insurance exists to help protect the assets and liabilities on the project balance sheet. And builder's risk starts by working to protect the asset side. So builder's risk is essentially project-specific coverage for everything that is going into and forming part of a finished project, whether that's a residential home or a factory that's going to be spitting out widgets. Builder's risk, often called CAR, EAR, COC, or all risk property, is coverage for what's going into that asset and protecting it during construction from damage, theft, et cetera, et cetera. It's the uniqueness of project-specific coverage is that it covers all of the asset stakeholders in one policy. The owner, the general contractor, the subs, construction managers, architects and engineers, suppliers, putting work into a project, etc. And what's essentially insured is that project, those bricks, those sticks, and that machinery that's going into and forming part of the project. An insurance policy is always kind of defined by its exclusions, and there are some specific things that aren't included in a builder's risk. Tools and equipment that do not form part of the finished project, being one. Property cargo that's undergoing marine transit. There are limits in the policy for transit while on roads and in local waters, that type of thing, set to a sublimit. Wear and tear is excluded. Things like settling, cracking, shrinkage, those types of scenarios aren't included. Latent defect or faulty workmanship isn't included. We could spend a bunch of time on this particular exclusion because there are some nuances to that with the relative design error coverages, exclusions in the policy that provide coverage carvebacks, or the London Engineering Group endorsements, the leg 2 and 3 that are kind of relevant right now. Pollution isn't included in the policy. Neither is delayed completion or terrorism. And then you'll have warranties on those policies often too, depending upon specifically things like the type of construction. If you're talking about wood frame and those types of scenarios, you'll see open flame warranties. You'll often see requirements around what you need to have from a watchman, security type of standpoint, and that type of scenario. There are also additional coverages that can be tacked on to a builder's risk. These need additional underwriting and consideration during the quote scenario. And those two coverages are essentially soft costs, which is poorly named because it's not really in alignment with what contractors or designers would call soft costs. It's more aligned to continuing expenses in the face of a claim. So if there's an insurable claim on a project and there are delays that, take things out longer and require specific amounts of coverage to help provide indemnification to the project, those can be covered under what we call soft cost coverage. And there's also delay startup, which is a business interruption product that can help support loss of profits should that claim manifest, delay the project, and slow down the scenario whereby you'll be able to generate income with that asset. Again, those typically have specific deductibles that are often on a daily kind of basis, but they're available and require underwriting prior to binding your risk. On the liability side of things, wrap-up liability coverage is designed similar to builder's risk in that it's project-specific liability coverage. Similar to builder's risk, it covers all of the asset stakeholders, the owners, the contractors, the subcontractors, and it provides third-party bodily injury and property damage coverage arising out of the project itself. I've heard different folks kind of suggest that wrap-up liability is duplicate coverage. I would suggest that that's an inaccurate analogy. It is primary coverage. It comes in over the general liability policies of the owner, of the contractor, of the subcontractors to wrap up all of the liability that exists in that project to create a more streamlined and a more streamlined claims flow in the face of an incident, right? Without a wrap-up liability in the face of third-party bodily injury and property damage, the owner is very likely going to get sued. The contractor is probably going to get sued because their name's all over the project site. And various subcontractors who may be responsible for the incident are also going to get sued. Then you're dealing with multiple insurance policies and multiple kind of philosophies or strategies about how to settle those types of claims. A wrap-up very much wraps that in to the project itself and helps insert an insurance company into settling that claim and moving the project forward. Again, notable exclusions in this scenario would be things like intentional or malicious acts, your work and your product, the particular part that you're actually working on, failure to perform, automobile, aircraft, professional services, again, pollution, nuclear liabilities, and those types of scenarios. It also excludes damage to the project itself. That's why the builder's risk policy exists. Here's a general comparison on the slides of what the difference is between general liability and wrap-up. Most specifically is the wrap-up is designed for all those asset holders, rather than the individual businesses that are working on the project. That's kind of it from my side. If there's any questions in the room, I'll field them now. If not, I'll turn over to my colleague Justin to talk about environmental pollution scenarios. Thank you, folks. Oh, there we go. Question? No. Here we go, Justin.
Thank you, Sean. Good morning, everyone. So I'm Justin Perry. I lead the environmental risk services at Aon nationally. So everything to do with environmental insurance, environmental risk transfer. I have a team around me that structures and places the insurance. So I'm just going to take a step back. I know we've talked about insurance for a little bit. So environmental insurance is fundamentally a different branch. If there is an insurance policy that exists, there's probably an environmental version of that policy. And that's the misnomer that exists in our world of insurance. So, why do people look for environmental insurance? Fundamentally, it can be different than regular insurance. So a lot of the time it's balance sheet protection. For those of you who are in the environmental sciences world, you'll know that you might have to manage an environmental incident for the duration of a project or for the duration of the asset life. Fundamentally different than causing an immediate liability that you're going to go and settle and deal with. So sometimes it's just having a financial offset for a period of 20, 30, 40, 50 years. The claims can be open fundamentally forever, depending on what the circumstances. Another major area is the gaps in other types of insurance. So sure, there might be elements of coverage that exist in other programs. I think Sean mentioned, you have sudden and accidental coverage, and I'll clear that up in a second, but there's sudden and accidental extensions available under a wrap-up. There is debris and soil and groundwater cleanup under a car policy or builder's risk program. Those are all sublimits typically, or limited in some way with a time component or various conditions. And environmental policy is not subject to that. We are really there for soil and groundwater cleanup. Then we give bodily injury, property damage coverage as well. I will talk about how we diverge from other types of insurance as well. Finally, one of the external factors that's critical is regulatory liability. We're one of the only types of insurance that actually covers a government entity as an order provider, as a third-party claim, and also prosecutions, fines, and penalties. So, first and foremost, just to clear up a couple of items. I'm comparing, this is a slide that compares to other types of policies. Fundamentally, every insurance policy that exists, there's probably an environmental version of it. So this is only talking on 3 of them. For those of you who are familiar with cyber insurance, the pipeline that was hijacked in the US a couple of years ago, the cyber insurance comes in for the digital aspects. If there was actually a spill, that would have come back on an environmental policy. So again, where we fit in is everything to do with the release of a pollutant. And that's the frame that we work in. So under general liability, there is no mention around cleanup typically or remediation expenses, silent on natural resource and kind of what is a public property rather than third-party property, and a whole bunch of other elements. I'm not going to go through the list. There are extensions of coverage, and depending on who you work with in the insurance broking community, what insurer you're working with, there are lots of misunderstanding around, do I get the GL-SNA or sudden and accidental coverage or the time element pollution, which is what it's really called? Or do I look at environmental policy? They do 2 fundamentally different things. Yes, there is overlap, but how you can procure them, the capacity that's available, when they respond, what they're intended to cover is different from the proximate cause perspective. And yes, it even extends down to directors and officers. So an environmental policy, any of the environmental policies, and you'll see there's, I think we have 14 different kinds that we issue in our world, cover directors on a primary basis before a D&O policy kicks in. So it even extends out there. So there are two different streams of environmental liability that exist. There's premises risk and there's contractors risk. So essentially pollution conditions or environmental conditions that commence at a fixed address or conditions that are caused by a third party while working on a construction project or while delivering services or operations to a third party. So the premises risk is really the owner's risk. So, and it cannot be transferred wholesomely to another party, whether you're a landlord, tenant, construction project owner, or contractor, or in a purchase and sale scenario, you can't transfer 100% of the environmental liabilities. You can always be brought back into it. So premises policy is, for those of you that are detail oriented, is a claims made and reported policy only. So it's only good for the time that it's in force, and you have to maintain that program indefinitely. That includes assets that you're no longer on. That could include construction assets for 30 years. You might need to maintain those if you're the owner or if you're the agent of the owner or if somehow you're contractually responsible to manage that exposure. The key thing here is that the responsible party doesn't need to be identified. The responsibility comes down to the owner. Did the release or has the pollutant found its way on the site? Is it on, at, under, or migrating from the site? So that's the trigger point for the policy, but it really is an owner's risk. On the flip side, anything that you do off of site or anything that a contractor comes in and performs on your site, there is a contractor's environmental liability policy. Now, this policy can be written on an annual renewable basis. And I would caution you, because this is focused on construction, is you're now, if you're accepting that as an owner, you're now accepting that knowing that there could be claims or erosion of limits on other projects that you're not aware of. And if I mentioned earlier that environmental claims can take years to settle out, 30, 40, 50. I have some that are with, I think, 10 claims open right now with an insurance company. I went bankrupt in 98. And they're not releasing the funds. So they stay open for a long time, and that'll be open for another 30 or 40 years. So environmental claims can stay active for a long time. On a contractor's environmental policy can also be written for a specific project, like a wrap-up. So it is there for all contractors, subcontractors, anyone who performs work or where work is performed on their behalf at a job site. These policies can be written on a claims made and reported or on an occurrence basis. There are pros and cons to both structures, and what is the object of occurrence is critical as well. So we can talk about that offline for hours. So I won't go through there, but I've brought back an old occurrence form, your quote unquote forever insurance from the 90s. We've brought that back over the last couple of years in the environmental realm, specifically for contractors on jobs, so that they don't have to renew the policy for 30 or 40 or 50 years for work that they've performed. The trigger here is much more dependent on the work performed. So it's no longer the presence at a site. Really here, it's a pollution condition that you've caused arising from a covered operation that's defined in the contract at the place you're supposed to be, so on the job site. So it's very defined to your work. And because of that, the timing or the temporal component of when the pollution occurred doesn't apply in the same way. It's really your actions and what liability you have caused. So yeah, speaking of temporal components, any owner has to be concerned of when they become aware of a pollution condition, but more importantly, when did that pollution condition first commence? So I won't go into great depths here, but a premises risk or the owner's risk really looks at when it first commenced. So there has to be environmental due diligence and there has to be a disclosure to the insurer for the insurer to take that risk. And then a response is simply to bring you back into compliance. Not unlike other insurance where it brings you back to the point prior to the loss. Here, the loss has already occurred. You're just becoming aware of it. So it's just bringing you back into compliance with environmental regulations. On the flip side, a contractor's policy really looks at what you do during the job. So if you exacerbate existing conditions, whether you had knowledge of it or not, that exacerbation is an insurable event. And that's the critical component to a contractor's environmental policy versus the owner's policy. So some of the high level components is that environmental policies do cover, again, everything revolves around the release of a pollutant. And that is a very broad definition. It does have a first party component. So it does have discovery and cleanup on your premises. So consider that a first party risk. It does have third party liability all blended into one policy. We did discuss the business interruption or delay in startup. So environmental policies can provide that coverage as well under one of the two programs. It does also cover the transportation of materials on and off site, waste materials, contaminated soils, you name it, fuel. And yeah, essentially it is a broad program for a very specific element. So what do we see? I mean, we see everything from mold, asbestos claims even today. I mean, I had a mold claim in a downtown skyscraper recently that you would have no idea. We just had, yeah, I mean, the mold actually burst out through the walls. That's how we discovered it from a construction job that took place 25 years ago. And it was a professional design error. But again, you wouldn't expect it. You know, it's not this bank, but one of the bank names is on the building, so it's a big building. You know, we do see the discovery of pre-existing conditions. When as soon as you put a shovel in the ground, you don't know what you're going to find. It could be naturally occurring. It could be something that occurred due to a prior owner, prior operator. It could be somebody who illicitly abandoned materials on your premises, so dumping. Somebody that came and dumped for years. We see those frequently. It could be a neighbor that 40 years ago had a spill and it's finally made its, you know, through the water table over to your site. So we see it all. There are very few environmental claims at construction sites that are a textbook, if you want. They're all weird. Just had my first mass timber mold claim where water got underneath the concrete slab during construction. Now we're the claim is currently trying to figure out whether the wood is still good and how much damage has the mold, now that it's been cleaned up, caused to the mass timber. You know, we think it's a 40% reduction in load capacity on a hybrid mass timber building, one of the larger ones in Canada at the moment. So weird, wacky, you know, didn't know that mold was excluded. Now you know that mold is excluded from a wrap up and other policies. So that hits the environmental policies. A big one in the municipal context is sewer and surface water management. So any kind of discharge into infrastructure and the damage that can come just from silt or, you know, dirt running off the site can score the pipes, can cause accelerated degradation of sewer infrastructure. So there's a lot of elements, even natural, or we'll say due to materials on site, that can cause impacts. In an urban environment, you're always dealing with fill material. You know, for anyone who is not familiar, the shoreline used to end basically at Union Station. So everything south of there is fill material. If you're developing, you will find something there. I think one of the, yeah, you're laughing, Jessica, you know, you've seen that. Everything from railway ties, I think that were just in the news recently. Somebody found railway ties 3 stories deep on a construction project through the waste disposal costs up to about 8 million in just disposing of old railway ties at a landfill. That was unexpected. So we step into those types of issues. And also, I guess I'd have to highlight air emissions. You know, noise, light, anything that leaves a site as a solid particle, a gas, etc., can hit an environmental policy. That is a release fundamentally and limited or excluded under other policies. So just as a finishing slide, I did mention that there were a number of different policies that exist. So we have premises-based programs that include, product liability or environmental product liability. Um, we also have lenders programs if your asset is your collateralized asset is the site and you don't want it to be contaminated, or what happens if it has no more value. And then we have our operations-based programs, which is the contractor's policy. We can also cover environmental professionals. Yeah, and infrastructure programs are typically an integration of both in some capacity. So on that note, I'll just leave it there if there's any questions.
Just to tie a bow around the insurance scenario, Justin and I have talked about kind of 3 of the 4 common policies that you'd see on a project. The 4th one would be professional liability or errors and emissions insurance. That is got its specific challenges, so we're going to save that for Bids and Bricks 3, whereby we'll get into that with a little bit more detail, with a little bit more nuance. So pass it on.
Great. So we do have some questions online, actually.
Yeah, sure. So one of the questions we have is for builder's risk, and CDC requires 1.1 times project value. What about when the project is a major renovation, i.e. an arena renovation, but the community center side is not being touched?
So the community center side that's not being touched would more than likely not be captured by the builder's risk. It would have its own property insurance to protect damage that may result out of the project. In that scenario, any damage that arose on the community center side that's not part of the builder's risk wouldn't be considered part of the project and would be captured by the wrap-up liability, right? Because that would be then third-party property damage. It wouldn't be part of the project itself, and would kind of go into that side of the insurance ledger for recovery. As far as the 1.1 times scenario, CCDC and many contracts call for the project to be insured to 1.1 times the project value. And that's for reasons of escalation of costs that could happen over the life cycle of the project, et cetera. You don't need, though, typically and most commonly, to gross your project value up by 10%. The policy has a mechanism called an escalation clause that accounts for 1.1 times the project value within the wording of the policy.
Thanks, Sean.
No problem.
Another question we have here is, we requested 5 million CGL for a project and were provided 2 million with an additional 3 million under excess. Can you explain the difference between excess liability and umbrella?
So an excess liability policy sits over an umbrella typically. What you'd want to make sure is that that excess policy picks up any coverage that the umbrella policy is covering. So there could be nuance in the language that says, for example, that the umbrella policy doesn't pick up things like motor vehicle, auto, that type of scenario. But in general, they're very similar. The question you want to ask is whether or not that excess liability policy is follow form coverage above that umbrella. And then also you want to know that that umbrella is picking up all the nuances of coverage in the general liability policy, including some of the sublimits, maybe things like sudden and accidental pollution, maybe things like non-owned auto, and that it also covers the automobile liability policy. So if an umbrella, for example, didn't pick up the auto policy and your contract was requiring $5 million of auto and they only had a $2 million auto policy, but the umbrella policy didn't include the auto, then that entity wouldn't have $5 million of coverage. So you'd want to make sure that that's the scenario there. But there's a minimal difference between excess liability and umbrella liability.
Thanks, Sean. A bit of a 2-part question here for both Sean and Justin. How do you go about determining limits for pollution coverage or for wrap-up liability?
Well, my blank is on, so maybe I'll kind of start. Builder's risk is a lot more intuitive around what the limit needs to be. It's stated in the contract. For wrap up, there's a lot more nuance to that. You really need to measure what your risk looks like. And you need to, potentially work with your broker partner to do some benchmarking for you to give you some context around what makes sense and what similar projects of similar scope would look like. If you're building a high-rise condominium, for example, in downtown Toronto, a densely populated urban area, there is a significant amount of third-party bodily injury and property damage that could arise out of that project. So even if a contract, say, called for 25 million of wrap-up liability on that job, you really need to think about whether or not that's enough, right? Does that make sense? Is $200 million the number? Is more than that the number? It's a little harder to put a pin in that, but it's something that you need to do with your project team to kind of determine where the risks and exposures lie. And you also need to work with your broker partner to help you kind of determine what makes sense and what is kind of more common in the market and what's attainable. You want to talk to pollution?
Sure, yeah, under the environmental side, I would say it's very similar. A maximum foreseeable loss in environmental can be immense, might be well beyond what is insurable in a marketplace. So it's really coming down to what is a common or a predictable loss value that you can come up with. Every job is going to be different. Every soil substructure is going to be unique. Every groundwater situation is going to be unique. Surface drainage. I've seen catastrophic, say, large claims because it was raining. I had, an event that happened out of a tank at a cement co, where if it wasn't raining, the loss would have been well below the retention or their deductible of a couple $100,000. Because it was raining, we're up to 38 million. How that's predictable, I couldn't tell you, but it really comes down to the specifics of the site and what the pathways and receptors look like. And, just to add to that, because I think we have someone in Ottawa that works a lot with the government there, will anyone care to enforce the regulation and how they will go to enforce that regulation?
Thanks, Justin. Yeah, we have a couple more questions. I think we're going to go to, can you elaborate on the risk coverages / purpose for environmental lenders liability products?
Sure, that's a whole other conversation, but essentially it's a premises policy that the lender purchases on behalf of the site owner for their exposure. So it pays the lesser of the outstanding loan balance or the cleanup at the site if it's impacted. Yeah, so it's a double trigger policy.
Sean, we're coming back to you with, does wrap-up liability coverage include suppliers such as concrete suppliers?
Yes, if suppliers are performing work on the project, then they would be covered under the wrap-up liability policy. If you're someone just supplying tiles to a job and you kind of go there and deliver them and you're not installing them yourself, you wouldn't.
Okay. And what would you suggest the minimum project value where we would request wrap-up liability?
I mean, I think wrap-up liability is more of a philosophical risk management decision than it is about size of the project. I mean, if a project's very small, you're looking at, working with a reputable contractor, reputable subcontractors, then you can make that risk decision. But from my perspective, a lot of owners and a lot of contractors make wrap-up decisions based on their risk management philosophy. And, if you are aligned to the idea of having wrap-up, you really want to have project-specific policies in place for your projects so that individual incidents at projects don't blow up your corporate insurance program and create, loss history scenarios that you have to deal with moving forward as you want to renew your corporate annual kind of term policy. And like I said, owners can have that philosophy, contractors can have that philosophy. Like I said during my kind of talk, there's the perception that wrap-up is duplicate coverage. I don't necessarily agree with that ideology. It's primary coverage. It's the first policy that responds for a bodily injury property damage scenario on a specific project. And there's a lot of benefit to that for the owner, for the contractor, for the subs, for all the stakeholders on that job, so that they can limit the liability on that project through the wrap-up for that project. So I don't know that it's a size scenario. It's more of a philosophy scenario.
Thanks, Sean. I think this will be our last question before we pass off to Graham. For builder's risk, would you only look to pick up existing structures if they were actually forming part of the project work? Example, if you're renovating an existing structure and adding an extension, you'd want to cover existing structure under the builder's risk rather than leaving it on the property policy.
I'm not sure I understand the question completely, but I'll give it a shot. I mean, I think ensuring the existing structure can be exceptionally difficult. Builders risk insurers want to insure the risk that's being built, right? The scope of work that's being conducted. If you're doing a renovation of $100 million building and your extension or renovation is worth $20 million, it's going to be very difficult to wedge that $100 million asset into the builder's risk policy with the insurers. So again, I'm struggling to kind of really get to the nuance of the question, but I'd say that that's kind of accurate. It's difficult to take on a massive existing structure under builder's risk. The property policy still exists for that asset that's being renovated or whatnot. The liability of the contractors working on the project exists to protect damage to that existing asset. So the necessity is kind of also TBD in that scenario. It's possible, but it can be very challenging if you're looking at insuring a massive existing structure under a builder's risk policy.
Just further to that, Sean, would that be the same if the contractor was taking custody and control of the existing structure?
That would really be the trigger for the scenario where you need to put the existing structure under a builder's risk. If the contractor is being given full care, custody, control of that existing asset, then it's their responsibility to insure it, and the builder's risk would be the avenue to do that.
Thank you. And just one last quick one. Can you touch on the applicability of owner-controlled insurance as it applies to large construction projects? Is this the same as builder's risk?
One more time?
Can you touch on the applicability of owner-controlled insurance as it applies to large construction projects? Is this the same as builder's risk? So I think the question's getting to...
Yeah, I mean, philosophically, there's a scenario where there's owner-controlled insurance placements versus contractor-controlled insurance placements. Builder's risk is just one of the risk management tools that you would purchase in either scenario to protect the asset itself. Again, a lot of it goes back to philosophy. You'll see larger, more sophisticated owners potentially that are doing a job over multiple phases, wanting to take control of the insurance process for a project. Contractually at the CCDC level, as an example, the responsibility for the builder's risk sits with the contractor, but we see that get changed by supplementary conditions, and we see that get changed in non-standard form contracts all the time. And it really boils down to what does the owner want to do and why they may want to take control of the insurance on the asset. And there are a lot of philosophical reasons around why you might want to do that. Yeah, that's kind of it in a nutshell. But OSIP versus CSIP and what builder's risk is in that scenario is, it's the same thing in both scenarios. It just depends who's placing the insurance fundamentally.
Okay. Thank you very much, Sean and Justin. With that, we'll be passing off to Graham from Gowling, who will be discussing procurement.
Thank you very much. So my name is Graham Reagan. I am a partner here in Ottawa. I am a co-lead of the procurement group, and we act for both owners and bidders, and we have assisted in preparing procurement processes and templates for owners, but I'm a litigator and I've also acted on a number of bid disputes. And so I kind of understand, our group understands this process from both sides. What I'm going to do today, obviously very quickly, and this is a complex area with a lot of nuance and a lot of details and a lot of law, is to just kind of go over sort of the highlights to give you a flavor of sort of the roadblocks and issues that can arise in a procurement process. And so first, in this first slide, we're looking here at the sort of principles that inform procurement. And depending on who the owner is, there can be a number of different things at play. Obviously, the principles behind this are, the attempt to get sort of value for money, particularly if it's a public institution of some kind, by trying to harness, the free market forces and using a controlled competitive environment. The next bullet there with fairness, openness, and transparency, those are really the core principles of procurement and inform really the trade agreements, the government policies, and the common law. And procurements can be informed, as you can see, there can be a number of different touch points to what governs procurement. It can be legislation, it can be policies, as I say, trade agreements. And even if none of that applies, if you're a complete private entity, the common law is still going to apply. And through the common law, the requirements in the particular solicitation documents will also govern the process that's applicable in each case. So if we can go to the next slide. So there's really a foundational contractual form to procurement, and this is the Contract A, Contract B model. And this originated, and it's been around for a long time, originated from a Supreme Court of Canada case from 1983 called Ron Engineering, which was actually a construction case. And so Contract A is really designed to put some legal protections around the bidding process. Contract B is really just the actual contract that's awarded and performed at the end of the day. But Contract A was introduced to reduce what was a series of issues that arose between owners and bidders in how they approached the procurement process, and really without having any contractual obligations until the formation of Contract B. So that's changed. And so now Contract A creates a binding, illegal, and enforceable contract between the owner and each compliant bidder. And the owner can be liable if it breaches Contract A. And there are a number of ways that can be done, for instance, by awarding the contract to a non-compliant bidder. And Contract A has both express terms, which would be the terms in the RFP or whatever the procurement document is, and implied terms. And the implied terms create an obligation on owners to treat all bidders fairly and equally. And this is otherwise known as the duty of good faith. And this is broadly defined, and it contains a number of different obligations. I've also noted here that Contract A is not always triggered. And what I mean by that is that it's not a definition. It's not a form that can be easily applied. There's a number of factors that go into it. It's a legal analysis that determines whether Contract A is formed. It's not unlike a determination as to whether a regular contract, or the Contract B in this case, is formed. So there are a number of indicia that look to whether Contract A is formed. So just by the fact that you have called something an RFP or not called it an RFP doesn't mean that Contract A is or is not formed. And so there, as I say, there are a number of features that need to be looked at to determine whether Contract A actually applies in that case. So we can go to the next slide. So these are just a sample of some of those duties that I was talking about. And as I say, because this is a common law obligation, it applies in a Contract A, Contract B model, regardless of the sophistication of the parties, regardless of the sophistication of the procurement documents. It's a process that creates a legal obligation and implies these obligations on the bidders and the owners. So there's a couple here that are important ones. The duty to reject non-compliant tenders. That's a big one. So if a non-compliant bidder is awarded the contract, that violates Contract A, duties of fairness, and can be grounds for a successful challenge to set aside that contract award. So these are or to award damages, depending on how the process is taken. So these are important duties that need to be considered every time there is a Contract A, Contract B model that's used. If we go to the next slide. So there is another approach which is rapidly gaining a lot of traction, particularly on larger projects. But I'm even seeing it with some clients on what I would say are medium-sized projects. And I'm calling this a negotiated RFP. There's many different terms that can be used to describe this process, but the key difference is that there is a negotiation of the terms and conditions of the contract. So in the contract A, contract B model, typically the contract is attached fully or nearly fully to the RFP, and bidders are obligated to accept the terms of the contract as a part of submission of their bid. In the negotiated RFP model, that doesn't happen. And so sometimes there's an ability to select some terms which will form the basis of a negotiation, but other times there's nothing at all, and the contract negotiation will unfold as part of the procurement process. Now, there is a requirement that this is clearly stated in the solicitation materials, and there has been some cases dealing with situations where that language is not clearly stated and issues arising with ambiguity there. But if that intention to negotiate is clearly stated, and obviously it makes sense to do that in order to give bidders the best opportunity to put forward a bid to understand what they're getting into, this is an option. And as I say, on larger projects, it can make a lot of sense because sometimes it's very difficult to fully understand the scope, even some of the contract terms and conditions, around payment or milestones at the outset when you're issuing the RFP. And this process allows that to be developed. And you can also do a staged RFP process where it doesn't necessarily have to result in a winner on the terms and conditions that are issued on day one. There are some abilities to modify that process too, but the negotiated RFP process really is designed to allow flexibility so that you're not in a situation where you've awarded a contract on specs that ultimately the contractor just can't perform in the manner that were specified. So if we can go to the next slide. So this just is a table setting out some of the benefits and risks. And obviously, one of the biggest risks and benefits is certainty. In the typical contract A, contract B model, because you're, as the owner, providing the full contract and mandating that bidders accept those terms, there's a significant amount of certainty to that process. And in fact, in cases where a bidder would, let's say, for example, prepare changes to that contract and send it back as a part of its bid submission, that's actually considered a counteroffer and they would have to be disqualified. So there is a significant amount of certainty in the contract A, contract B model, and a lot of control. It is the most advantageous for owners to use that model if they want to demand bidders to do certain things under certain conditions. Obviously, the risk with that, though, is it's not flexible. And so, as I was saying, the biggest benefit of a negotiated RFP process is to allow for there to be dialogue, discussion, adjustments, either to the specs in the RFP or to the contract terms, so that there isn't a situation where either you've negated bidders who would otherwise participate, so the bidding pool is small, or you reach a situation where there's just a lack of consensus on contract terms, and often, and Matt's going to touch on this, I'm sure, in his presentation. You don't want these issues to arise in the contract phase, and if there's a way to address and resolve these issues at this phase, it's a far better solution. And so it really depends on the project. I would say, for smaller projects or for less complex projects, the negotiated RFP process may not make sense. It obviously takes more time. And another factor with it is that it doesn't mandate a solution in the same way. In other words, bidders aren't bound to perform the contract. If the terms aren't negotiated and either the bidder wants to withdraw or the owner wants to cancel, that can happen. And then you're looking at negotiating with the second or the third. And so the process, if the negotiations are extended or difficult, can take longer. And again, that's not really a concern in the contract A, contract B model, because if they're submitting a bid, they're agreeing to the terms of the contract. If you award the contract to them, they must perform it. So it is a question of certainty, but it also is a question of flexibility. So if we can go to the next slide. Keep going, procurement communications. So we're just going to touch on some of the drafting considerations really at a high level here. As I say, this is a pretty complicated area with a lot of nuance. So, in terms of communications, typically the main forum for communications is the question and answer process. And for owners, it's the use of the clarification rights. And so, the question and answer process can be fraught with all kinds of considerations for bidders in terms of, do you want to ask a question? How do you ask the question? Is it confidential? What if we get the answer? What if it's not the answer we want? There are a lot of considerations there. For owners, though, it's really a question of defining the scope of the RFP. And so the use of addenda is really key, and for both owners and bidders, because that is effectively changing the terms of the RFP and or the contract, depending on the changes that are being made. And those changes can be made, as I say, as a result of questions, as a result of clarifications, or just independently. And we have two other sort of forums of communication on that slide. Meeting with proponents. I think we're primarily talking there about sort of a pre-bid meeting. Those can be useful if there is some novelty or uniqueness to a procurement process, or it's engagement with an industry or a collection of suppliers that the owner is not familiar with, and equally for owners, if they're not familiar, or bidders, if they're not familiar with the owner, it can provide some opportunity to get a general overview of the procurement and what's going to unfold. The other is post-bid clarifications. It's a big caution there for owners on post-bid clarifications, because we do not want to be crossing over into bid repair and allowing a bidder an opportunity to improve their bid after the fact. But in some cases, you're knee-deep in the evaluation and there is some ambiguity. And again, it's better to seek a solution to that at the time, as opposed to taking a chance that you've interpreted correctly and finding out later that you didn't. And if we go to the next slide. So one of the obligations in the duties of fairness is that evaluation criteria must be clearly set out. And this is designed to provide bidders with the information that they need to understand what they need to respond to and how they're going to win. And so it doesn't require sort of infinitesimal detail. You don't need to provide the Excel scoring sheet that may be produced internally to help the actual evaluators, but there has to be enough information so that the reasonable bidder can look at this and understand what they need to do to respond to each of the criteria and how do they win. And we have at the bottom there a phased bid compliance approach. This is again something that's starting to get some traction, and primarily the main way it's being used is to allow a period of rectification for mandatory requirements. So it used to be that mandatory requirements, they were lengthy, they were throughout the entire RFP, and if you failed to meet one, your bid had to be thrown out. And that approach is really past now. And the idea now is to very much limit the mandatory requirements and also to provide a limited opportunity at the discretion of the owner to correct those particular issues. And just a quick example that I've been giving for years, and it's a case that was a defense procurement for footlockers that would sit at the beds of I believe it was infantrymen at the time. And the mandatory requirement was for the handles to be black. And one of the bidders had a fully compliant footlocker, but its handles were green. And as a result, it had to be disqualified. And it challenged this because obviously there was no operational difference between a green handle and a black handle. But because it had been stated as a mandatory requirement, it had to be disqualified. So again, that approach is starting to be phased out. And looking at other approaches that still keep the requirements that are necessary in order for the bid to be considered, but providing an opportunity for bidders to correct on, as I say, on a limited basis, those sort of unrelated to technical or pricing considerations. And if we could just go to the next slide. So, a big part of a procurement package and procurement documents are the reserved rights and limitation of liability. There's a lot here that we could talk about, but really it comes down to there being some ability within the courts who've looked at the application of these clauses to relying on these rights. And in fact, there was a case from the Yukon Court of Appeal a couple of years ago, which looked at a limitation of liability clause between two sophisticated bidders and actually agreed and applied and limited the liability of the owner in that case to what was probably a pretty viable procurement challenge. So these are important clauses. Sometimes I've seen them very quickly inserted or not fully developed. These are important clauses, and in a particular case could be the difference between liability or no liability arising from a procurement process. If we could just quickly go to the next slide. So these are just some drafting best practices. I mean, obviously, the first drafting best practice I would recommend is having your RFP documents looked at by legal counsel. I think it's important if they haven't been looked at in a while that they be updated and checked. I know from experience that oftentimes these procurement documents go through a bit of a Frankenstein approach where they're updated project by project and not necessarily looked at in the totality. And it's a good project to undertake, even if it's a bit costly, because it will improve the overall documents at the end of the day. As I say, really bidders have to have the information that they need in order to understand what they're bidding on. And there should be an alignment between the bidding documents and the contract documents. And I work closely with a lot of my colleagues in the different areas of contract, because that alignment will allow there to be symmetry both with the evaluation in the procurement process, but ultimately with trying to select the best bidder and contractor for the project at the end of the day. So I think Matt and I are going to split questions at the end, so I'll turn it over to my partner, Matt.
So I'm going to deal with contract implementation in the next 6.5 minutes. So it's a simple topic. Certainly happy to dig into it later and get into the questions, but in the interest of preserving some question time, let's jump into it. I think within contract implementation, what I mean is sort of what happens that's not the actual work under the contract after you've signed the contract. It's an area we've been spending a lot of time, myself and a number of our dispute resolution colleagues, in sort of helping our clients prepare in advance on sort of a ounce of prevention is worth a pound of cure basis, to put in place a whole number of systems, procedures, processes to enable the effective management of the project. It's not putting on your armor for a fight right away. It's actually sort of, in a lot of ways, avoiding the need for a lot of fights by making sure that you have the information, you're delivering the notice in a timely way to the extent that there are these issues that arrive that you've negotiated into the contract as resolution mechanisms and risk, and to make sure that everything is done, all the I's are dotted, T's are crossed to the extent something arises, rather than sort of a fight. So that's what I'm going to talk about mostly. today in the couple of minutes. I think the anchor principles that we'd have here are sort of planning and preserving your evidence, what that looks like, how your systems are made, what sort of governance policies you're putting in place at the project level to make sure that issues are identified, raised, frankly, diffused if possible, or mitigated to the extent that they can. Understanding your contractual entitlements, meeting your notice obligations, and that's in sort of time, form, and substance. And where changes do arise on the contract, sort of managing the process deliberately. I think sort of, we've talked about the contract implementation as a proactive operational discipline and not just a check the box activity. I think the other one is obviously to address the notion that, advancing a contractually permissible claim is a fight, an adversarial process. It's certainly incumbent upon the contractor to deliver the notice and to give, all of the substantiating information. Likewise, it's the owner's duty to itself, to its taxpayers, to whoever it is to ensure that, the claim advance meets the standard required by the contract that's been negotiated. It does not always have to be adversarial. In fact, it often works better when it's not. And disputes down the road are costly, and so there is some value in dealing with these early. I would say sort of the key point, the outcomes of claims is often heavily dependent on what happens in the first 60 to 90 days of that claim, even though you might be settling it years down the road. And so how you set up the systems, educate your team, and embed the contract are quite important. So we've talked about that, setting up the evidence early. There's immense value for contractors in investing to set up your policies, systems, and procedures immediately when the contract starts, rather than waiting until the first sign that a change or claim needs to happen. Under sort of scenario one, you've prepared, you're diligent, methodical, organized, and dispassionate in sort of assembling these contract documents, because you've got the systems in place, you've pre-drafted what your forms of notice look like, you've sort of set up what sort of evidence you're going to provide to substantiate the claim. On the other, you're in an absolute scramble because something's happened, you're writing everything from first principles, you're trying to get it in under the notice provisions, you might miss something, you might not be filing it properly, it's stuck in some guy's note, outbox. And you're looking for it years later, and you're scrubbing through people's documents rather than your document management system. People leave the organization, so it's very important to have that set up. And sort of the second bit of that is don't assume that institutional knowledge is institutional. And again, people move on from projects. I know we try to keep key personnel on as much as humanly possible. The fact is sometimes they move for personal reasons, sometimes there's retirements, there's illnesses, there's whatnot, and sort of looking for that information later rather than having a good set of contemporaneous notes that have been filed and taken is a huge difference in sort of the quality of evidence that comes. Often you're sort of all playing with missing information that frankly, had it been around, you could probably diffuse and solve the situation a lot earlier. So don't just assume that because some guys got it and it's in their inbox that you've got it forever. It's just not always the case. So the next slide, and we'll sort of hit this one fairly quickly, is just to know your contractual entitlements. And the your is underlined there. We've certainly seen a number of circumstances where somebody is absolutely sure the contract says X, and what they're really talking about is the contract that they've done 3 ago. And they're pounding the table and fighting a fight that frankly shouldn't have been fought in the first place. I've seen that on both sides of the aisle, so nobody is immune from it, but it's really important that you know your contract. What we do recommend from an early stage is to sort of map the pathways, so almost create a project handbook that we've helped clients with before, as to sort of what are the pathways that affect time and money into the contract. Where are you entitled to relief? Flag those very early, anything that affects risk allocation. as you're going onwards sort of, and you're determining, should we be advancing a case here? You align the facts of your situation with obviously the contractual tests, causation, what your entitlements are under the contract, and always respect the constraints in that contract, because it always says, hey, you get this. And then there's quite often sort of an exclusion. If you have done X, then you don't get it. There's often concurrent delay rules, which limit what you're able to get, caps and obligations to mitigate. All of those really do need to be complied with in order to effectively, one, manage the claim that you're going to have, and two, sort of to continue to push forward and sort of scope it and decide the size of it and what you're actually pushing forward. Likewise, in notice timelines here, know your timelines, know your timelines, know your timelines. A lot of these contracts that we have in Canada, notice can either be a condition precedent to relief. I think at the gentler end of the contract, any delays in providing notice you have will be taken into account when determining your entitlement, which is effectively shorthand for if the owner is prejudiced by the fact that you've delayed putting in your claim, you may not necessarily get all of what you're claiming for to the extent of the prejudice. On the other hand, there are contracts, and the old MTO contracts come to mind, although I haven't seen one in the last couple of years. But those are a total bar to your ability to claim if you don't get it in on time. And you can come up and it could be valid and everything like that. But if your notice is 2 or 3 days late, too bad, so sad, you missed it. So knowing the timeline is very important. Secondly, sort of meeting the requirements of that notice. So it's not just, hey, something's happened and we reserve our rights. If the contract says, let us know what's happened, I think there's the form and there's the spirit of it. The idea is you're really trying to give the owner sufficient information so that they can govern themselves accordingly. They might be able to say, go ahead, do something, we'll solve it later by way of change directive. But if you're sort of giving limited information and you have more, often you're prejudicing their ability to, deal with the situation as they see fit as well. So if the notice says you've got to give a certain amount of information with your notice, do it. A lot of provisions will have a follow-up obligation that says, let us know right away that something's happened, give us additional details within a certain amount of time. That's very important to make sure that your team is done. The other one is, and this is sort of one that I hear often from the guys on the ground, is there's a hesitation to become too contractual and deliver the notice and sort of kick off what they think is a fight for that. And I think there's a real art in this as well. So your notices don't have to be super aggressive. They can be factual, dispassionate. I think it really should be instituted that the notice should be there. It preserves your rights under the contract. It should be delivered in a way, aw shucks, I'm sorry, I've got to do this, or hey, the contract requires us to give this, just to give you a heads up, something's coming down the pipeline, give me a call if you've got any questions, right? The way you manage it is quite important as well on that, but failure to give those notices can actually be fatal for your time. At the same time, document. So once the claim is there, you're starting to have a system in place that you set up where you've got, your work notes for the day, any discussions, any minutes of any meetings, you've got photos of what's happened, all of that evidentiary basis. One, helps the parties right at the outset. Two, is, it's contemporaneous, it's high quality evidence to the extent that it ever gets the multiple steps down for dispute. Change, execution. I think this one's maybe better left for another day, just given the amount of time, with apologies. And we'll move on very quickly and then hop to some questions, because I know Graham had some very interesting points there to raise, and I'm sure there's questions on that. A couple of best practices. One is just to make the contract visible. It's not something that you throw on a desk the day that you get it, although that is often the intent. We see sort of clients that run successful projects. They've got a handbook, a playbook, where there's sort of a clause matrix, an identification of the different areas mapped to the project, where there's timelines, there's it's a key issue, page and a half, quick summary, bam, bam, where you can find it in the contract. It's a great resource for teams, especially those a little bit down the chain that aren't necessarily seeing the whole contract. The thing is, you can't just rely on that. You've got to go to the contract, but it's a great first step to have for parties, and we highly recommend it. Institutionalized discipline up and down the team there, empowering people to identify issues and raise them up promptly is very important. Having an issue log, understanding who's authorized to do what within your governance structure and who on the other side is able to do that as well. Invest in the evidence. As I said before, contemporaneous records are one of the highest quality evidence that you can get if it ever goes to disputes. And frankly, it's just documented for everything. The typical cost segregation, production metrics, anything like that should be raised or kept as well. Stay collaborative. I emphasize this one. I think a lot of disputes go sour because it becomes adversarial too quickly. There's certainly a time and place for it, but at the start, it's a common approach to a problem. Stay collaborative, but protect your position. That includes the giving of notice and sort of complying with everything that you need to do to preserve your claim there. And finally, we recommend using the full extent of the dispute architecture where available. A lot of these contracts now have sort of adjudication. It has a combined disputes board who can give you a pretty good, although not always perfect answer, but often it's a good enough push on. It allows you to sort of test out the waters on your claim early. Just even executive negotiations are great. So use those. We think they're quite useful. And I will cut it off there and turn it over to Jessica.
Great. Thank you so much, Matt. And definitely, if you would like to hear more from Matt and on contract implementation, please do let us know in those feedback forms. We can certainly come back to this next time. We do have a couple questions online. So while those of you here in person are working up your bravery to ask, we'll go to the online questions. So this is for Graham. The tender document has language that allows the owner to cancel the tender if there's a budget constraint. Can this be enforceable if all bid amounts come in greater than the owner's budget?
Absolutely. And this is frequently a clause I recommend for particularly government entities, to allow them the flexibility to do exactly that. And often it's a issue of scoping of the contract, and sometimes again, going back to what I was talking about in terms of the contract A, contract B model, the risk here sometimes is that you miss the mark. And certainly if all the bids are over the budget, you're going to want to have language in, and it is enforceable to do that.
Great.
Can I throw in one
Please,
plug on that
yes.
as well? And Graham, let me know how this
Yep.
works from a procurement standpoint, but we've seen this a lot in making the number available, if not even within the document, sort of known to all the parties in advance. In a procurement really helps. I think one of the worst things is everybody invests the $1 million plus it takes to bid a project on these major projects, sometimes 2 or 3, and then sort of comes to find out they're all well over the cap when they would have been happy to engage in scoping decisions early in discussions at that stage. And I know you don't want to like fix a number sometimes because everybody bids to that. And there's a concern that if they were under, now they're above. But at some point in time, sort of putting it out there allows the parties to say, hey, this is unfeasible to bid this way, or we shouldn't be in this project if you think you need it that way, or to have a productive conversation at the outset before, through some of these pre-bid meetings where you can sort of sound off with the bidding community on that.
Yeah, I've definitely seen it both ways. I mean, I think from an owner's perspective, there's obviously some risk to disclosing the amount. And if it's a big enough project, quite frankly, it's probably something where you should be looking at a phased or negotiation RFP anyway, because there's a good chance that you're going to have those discussions about scoping and so on. And it's better, as I say, to do that during the process than sort of waiting and hoping for the bids to come in.
Apologies, everyone. My mic died when I was sitting there asking questions, but this is a great time to wrap up. So a huge thank you for all of you for joining online and in person. Special thank you to our presenters for today. Would love to hear your feedback again. So hopefully we'll see you next time, next month. Thank you.